afternoon and welcome to today's Premium Account Market Update for November 2014. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today myself, Leon Hine, Managing Director of Investor Signals. I have over 17 years of experience in the financial services industry as a licensed securities and derivatives advisor. The topics for today's presentation is a quick summary of the macro update or the events driving global equity markets. We roll through the ASX Top 50 with a particular focus on the 2015 portfolio strategy, which includes a review of the dividend yields and the PE ratios and the earnings outlook in light of the current adjustment in share prices that we've had in the last month or so, and we conclude with a portfolio allocation review and the Australian share market outlook. The Investor Signals Premium Account Service is a managed broking account where we work in partnership with you. It's based on a model portfolio of ASX Top 50 stocks. We utilise call options to enhance portfolio returns. We're focused on effective ownership around ex-dividend dates and generating above average cash flow as well as allowing for capital growth. It's all managed under strict investment mandates, so suitable for self-managed super funds, and the assets remain in your name. If you'd like to know more about the Investor Signal service or discuss the portfolio strategy with me, please contact me on the details on screen there. Moving straight into a graph of the US market at the moment. Now, if you go back to our October recording, generally the comment that I had made is that we were looking for the market to correct roughly 10%. The US fell just short of that, and we've had a substantial rebound. Now, this rebound has largely been driven by a result at a macro level. We've seen the quantitative easing conclude in the US, but we've seen Japan start, and we've seen a strong indication that the ECB is going to provide stimulus for the Eurozone. Now, net, what that still means is the world is a flood with cheap capital that's still chasing yield, in particular the adjustment that came out of the BOJ in Japan there with their quantitative easing is that they're increasing their allocation of capital towards the equity markets, both their domestic market and international equities. So it continues to underpin markets, and that's essentially been our thesis, is that whilst the US quantitative easing or stimulus measures subside a little, the prospect of Japan and the Eurozone picking up that slack increases. I still think that the risks remain that Japan's provided a lot of stimulus over the last year or so without necessarily delivering ongoing stability in their economic recovery there, and the Eurozone, we're all well aware of the problems that exist there. So I don't think it's likely that we'll get the same reaction out of equity markets as what we've probably enjoyed over the last few years as a result of the US stimulus. But I do think the central bank policies there continue to underpin equities, and I think it sort of still remains a buy on the dip story for equity markets, and in particular the big shift's probably been in the currency market. So before I move on, I'll just conclude here on the US equities following the September quarter earnings. Consensus is that financial year 15 will grow at around 8% earnings, which puts the US market somewhere around 16,500 points as probably fair value. So I think we're likely to see the market maybe push a little bit higher up to around 17,700, and I'd expect to see a top in place as the market reaches that level. In the currency market, here's where we've seen some of the big shifts. So as I mentioned, as the US has concluded their bond buying program and reduced the stimulus, what we're seeing is that increase in Europe. So you've got this divergence in strategy where essentially the ECB's having to continue to look at easy monetary conditions with lower interest rates and ongoing stimulus. The US is probably moving into a slightly different scenario where maybe over the next 12 months we have interest rates rising in the US and reduced stimulus, and what you're seeing here is the euro dollar fall against the US dollar, as we've seen the Aussie dollar do the same, and that's obviously had an impact on some of the Australian equity markets. Also at a macro level, the US 10-year treasuries, I'd spoken in the past about the need for these treasuries to ultimately start heading higher in order for it to feed into this view that US interest rates are on a path to sort of a more normalised levels, which obviously the market's looking for interest rate increases to begin in the US towards the end of next year. The panic that occurred in the bond market there is really off the back of sort of these deflationary pressures that are still fairly embedded in the global economy, and the deflation story is probably the greatest risk to the global economy, in that if the quantitative easing that the ECB and the BOJ are undertaking at the moment don't lead to improvement in economic growth in those regions, then can the US do all the heavy lifting on its own? And that's probably the biggest question that equity markets face over the next 12 months. I think they probably can do. I think sort of those stimulus measures underpin the market, and gradually we continue to see ongoing asset inflation in both property and equity valuations, which gradually restore consumer confidence and improve sort of business conditions. So we'll revisit these 10-year treasuries in the months ahead, but gradually we'll be looking for these to trade up to sort of around 2.5% yield there, and then begin to sort of consolidate before we move higher into the early to mid part of next year. Okay, on that note, and just finally at the macro level, I'd also spoken in past recordings about the flow of capital out of the Eurozone into Asia, and this is reflected here in the Shanghai Composite. We've seen sort of the German index, the DAX, continue to sort of fall away. We've seen during that same period the Shanghai Composite rally. I think that's probably a theme that continues. It appears for the moment that some of the worst readjustment in the Chinese housing market has probably finished. Some of the early data over the last sort of 4 to 6 weeks would suggest that sort of stock clearance rates and price stabilisation's occurring, and hopefully that sort of sits with our view that probably a base is forming in the Chinese economy, and that larger consumption over the next year or two should continue to underpin, I think, an improving equity valuation there in China. Okay, let's move straight into the ASX top 50 stocks and start moving through these pretty quickly. So AGK, we like this name. I think it's good value down here, 4.5% dividend yield, 14 times earnings. With the acquisition of the Macquarie Generation electricity assets, I'd expect AGK to trade back up to around $14.50 here. I think it's one of the better value equities within the top 50 at present. Asiana, I think a little bit expensive up here at these levels. The company's been focused on cost cutting to drive the bottom line growth on a 15 times forward earnings, 3% dividend yield. I think it's expensive. I only want to have a look at it back below $6. Amcor, with this improving or the strong US dollar and around 10% underlying earnings growth, the stock's really having a strong rally here at the moment, but needs to be put in context. Trading about 19 times next year earnings on a 3% dividend yield, or 3.5% dividend yield. I think it starts to run into resistance. But I think if you step back and say sort of where's Amcor likely to be in 3 or 5 years' time, I certainly think it can trade up towards $15. So we're wanting to keep exposure to that in the months ahead. AMP delivered a good result in earnings season, looking for about 5% earnings growth over the 12 months ahead. Stock trades about 4.5% dividend yield. For our money, we're only interested in it on a pullback to around sort of $5.50 thereabouts. The banking stocks all come out with their results as a blanket number, underlying earnings growing somewhere around 7 to 8%. ANZ, interesting just from a technical standpoint, and I'll point this out on a couple of names as we roll through them. It's one of the first times we've seen these lower high structures occur, so the distribution indicator coming in after structural lower low and a lower high here. Now, to put some numbers on ANZ, the stock trades about a 5.5% dividend yield, 5.5% yield, and about 12.5 times PE ratio. I think the banking stocks will be well supported coming into their ex-dividend period, and we're likely to see them recover those dips. So you've got ANZ, NAB and Westpac all going ex-dividend in the days and week ahead. APA, not doing it there at present. ASX, we continue to like this name. We've been buyers of it off the low here. As it trades up to around 37.50, I think it's an opportunity to look to sell covered calls. The stock's trading about a 5% dividend yield, which is attractive relative to some of the other names in the market that are delivering similar underlying earnings growth, which is around 5%. The stock trades about 18 times earnings at around this 37.50. I think it's an opportune time to look to sell the covered calls, and we'll look to collect that upcoming dividend in February, as well as the call premium, which will effectively give us an exit price back up here to around $39. So ASX, I think, one of those good value opportunities in the market. AZJ, we're buyers of this off the dip here. I think the stock's now back at fair value, puts the stock at about 4% dividend yield, about 16 times earnings. The company delivered about 13% underlying earnings growth in FY 14. I think on a forward outlook that sits at around 10%, and the stock should consolidate around here, so a good buy right opportunity for portfolios. AZJ. BHP, trading about 3.5% dividend yield on about 13-14 times earnings. Obviously they've had great production data in the petroleum and energy division of the business. BHP's, as with many of the resources at the moment, is all about reducing capital expenditure, getting the most out of their current mines, and increasing capacity. The shipping volume of iron ore still continues to remain strong. BHP is our preference for resource exposure, and we intend holding BHP right through to the split of the Newco business away from the four-pillar sort of assets of BHP, which will likely take place ahead of June next year. So we're locked into BHP for a while we wait for that corporate action to take place. CBA continue to like, Brambles, trading at around 22 times forward earnings on a 2.5% dividend yield, so expensive by any measure. The company's just reaffirmed that the underlying earnings growth is likely to come in at around 10% earnings growth over the 12 months ahead. I still think, we were buyers of it here at lower levels. I've maintained that up at these levels we need to look at selling the covered calls, and I still think that's the case. A combination of that call premium and dividend income, we're getting about 10% growth out of Brambles, or 10% cash flow, and allowing for some capital growth. CBA, a strong banking result, around 8 to 10% underlying earnings growth. Up here the stock trades at around 5.2% dividend yield at about 14.5-15 times earnings. I think we're in an environment where the banks stabilise, they move sideways, and they're a good opportunity to run a buy right strategy to again drive that sort of dividend yield up to closer to 10% as a result of the call premium and the dividend yield. Coca-Cola, we've seen the parent company come out and take a 30% equity stake in the Indonesian bottling business. That'll put around $500 million of cash back into Coca-Cola Amatil's kitty. The underlying earnings growth of the business over the next 12 months is probably going to be pretty flat. I don't think we can expect to see a drastic return to earnings growth. The company's put in place a cost-cutting program that'll see about $100 million of costs stripped out over the next few years. At this level, the stock trades at about a 5% dividend yield. We should collect a 23-cent dividend in the February period. We've now looked to sell the covered calls as a way of driving cash flow out of Coca-Cola. Again, bringing that sort of income up to around 50 cents per share over the next 12 months from that call option and the dividend yield. Computershare, look, interesting, the market was looking for about a forward earnings guidance, probably somewhere in the order of about 10%. The company guidance was actually pretty conservative at around 5%. So if we sort of take the middle ground there, that the company delivers about 7% over the 12 months ahead, puts the stock on about a 20-time earning and a 2.5% dividend yield. So again, I think it's good value from the context that a lot of its earnings are in US dollars, but again, really only from a view of running a buy right strategy. I don't think sort of the upside's much above $13.50 in Computershare, but I think owning it at these levels and selling selling the covered call makes sense. CSL, 10% earnings growth over the 12 months ahead, another $900 million share buyback. Up here, the stock's pretty expensive, trading about 25 times earnings on a 1.5% dividend yield. So again, it requires that covered call strategy to complement the returns. Crown, we've seen their earnings out of Macau soften a little. However, with the stock down here at trading at about 2.5% dividend yield, about 16 times earnings, I think it's starting to look okay value. I'd expect to see Crown stabilise at or near these levels. Fortescue not doing there at the moment. Goodman Group, underlying earnings growth about 6 or 7%. The stock trades now on about a 3.8% dividend yield, so getting pretty expensive and not much left in the way of yield compression there in Goodman, but certainly one of the faster growing property assets. GPT, about 3% underlying earnings growth. The stock trades about 5.5% dividend yield, about 14.5, 15 times earnings. So coming into its dividend period at the end of this year, it's had a good run here. Up at around 4.20, I think, is full value. From a dividend yield perspective, the company should pay out about 22 cents, so the next dividend will be roughly around 11 cents. And I think sort of owning GPT at or near these levels, collecting the dividends, selling the covered call, makes sense in portfolios as well. IAG still stand out from a valuation standpoint, 5% dividend yield, 12 times earnings, should deliver about sort of 8 to 10% earnings growth in the 12 months ahead. Any opportunity to buy in on a pullback, I think, is an attractive addition to portfolios. IPL, we're seeing gradual momentum return here to IPL. DAP prices stabilising around $450 a tonne. We're seeing better production data out of the Maramba plant, and the new plant that IPL's building in Louisiana in the US should be commissioned and online in 2016. I think in this environment IPL can probably trade up to 310, 320. Don't see too much upside above that. The stock trades on a 4% dividend yield and about 12.5 times earnings. James Hardie, look, no doubt the US housing recovery is continuing to gain momentum, maybe not at the pace that James Hardie or investors had initially anticipated. The stock trades about a 5% dividend yield, and I think, as I'd highlighted, it really starts to form a base here at around this $12 mark and probably represents an interesting opportunity for portfolios. Lendlease is getting too expensive for my liking, trading now up at around 15 times forward earnings on a 3% dividend yield. I think back at around $14.50, happy to take a look at Lendlease. Macquarie Group delivered a good earnings result, should deliver about $3 of dividends per share, around $1.50 each half. The earnings per share for the underlying business at just over $4 puts the stock about 15 times forward earnings, but I think bringing this in line with our view on the overall index, I think the market starts to run into resistance and we don't see too much upside for Macquarie short term. NAB, probably the worst out of the banking results, but that is not a surprise. Investors are really looking for some further evidence of a divestment of assets in the UK and in the US. The stock trades about 6% dividend yield, about 12 times earnings, and approaching its ex-dividend period in the coming days. Newcrest Mining, good production, one of the lowest cost gold producers. Obviously with gold down at $1,200 or $1,150 an ounce, Newcrest is under pressure. One positive light was that we saw the company retire roughly $100 million of debt out of their cash reserves. The CEO sort of pointed to that as evidence that it's unlikely that the company will need to do a capital raising to shore up its balance sheet, but really the story doesn't change here unless gold trades back up to $1,400 an ounce, which, whilst the US dollar's heading higher, seems like a difficult task. It's unlikely that Newcrest trades too much higher in the short term. Origin Energy, I think, is okay value down here after this recent sell-off. The stock trades about 19 times forward earnings on a 3.5% dividend yield, looking for the company to deliver about 8% earnings growth in the 12 months ahead. So we're buyers of Origin again down here at this $14 level. Oil Search, I think this makes sense to start adding this to portfolios over the next 12 months. We're likely to see the company gradually increase their dividend both the payout ratio and the net value of the dividend should be somewhere around 20 cents a share over the course of 2015, which is double what they paid out the prior year. So on this pullback at around this $8.50 level, I think it finds support, and it's a reasonable buy-right addition to portfolios. QBE not doing it there at the moment. Ramsay Healthcare, I'd highlighted that it was good value down here, but again, to keep that in context, it's good value within an expensive sector of the market. And to put some numbers on that, Ramsay trades at about 27 times earnings on about a 2% dividend yield, and the market's already looking for around 15 to 20% earnings growth in the 12 months ahead. Rio, so again, our preference still remains BHP over Rio, but at these levels, to put some number on it, the stock trades about 3.9% dividend yield, about 12 times earnings, and possibly we may see some downgrade to the earnings outlook for these resources, given where iron ore is sitting at present. SCG, this has been a strong performer here. SCG trades on roughly a 5.5% dividend yield at about 16 times earnings. Interesting to see ultimately what price they fetch for the Australian New Zealand property assets that they need to sell down to reduce that gearing from sort of where it's sitting at the moment at 40%, probably down to lower 30 range. That's probably the only risk that I see to SCG in the short term, is whether they achieve the price that they need for the sell down of those assets. Stockland, so we own this name from lower levels. We'll collect the December dividend, which will be around 12 cents a share. The company's reaffirmed that on a 12-month outlook they should grow earnings somewhere in the order of 6%. I think that underpins Stockland's share price, but around about a 5.5% dividend yield, it consolidates and moves sideways. But, you know, if you probably move out another 12 months, we could see Stockland's trading sort of more in this $4 to $4.50 range, I think. Sonic Health, we've started to take profit here after owning it at lower levels, and that's really just a valuation issue. The stock trades at about 19 times earnings, and it's compressed down to a 3.5% dividend yield. Considering that they're only going to grow earnings about 5%, I think it just starts to make Sonic look a little bit expensive, and we'd really like to pick it up, you know, on a pullback to around that $17.50 range in the months ahead. Santos, like Origin and Oil Search, I think it makes sense to start accumulating these names. You really have to have a 6-month outlook on the turnaround for these, but you know, somewhere down here around $12, I think Santos starts to look okay value. On a forward dividend yield, the stock's trading at about 4%. And again, like Oil Search, we should see gradually increasing dividends from Santos. Suncorp, I think this actually starts to look okay value relative to the rest of the market. So trading at about a 6.5% dividend yield on 14 times earnings, they should pay out about almost $1 in dividends per share, and still investors have the chance for special dividends in the 12 to 24 months ahead. So for the first time for a while, Suncorp starts to come back onto the radar as a potential opportunity. Sydney Airports, we like this name. We were buyers of it down here at around $4 at $4.50. It still looks okay value at a 5.5% dividend yield. Transurban coming into their December dividend. We like this name. They should pay around 19 cents of dividends for the December half at around $8.20. The stock's on a 4.5% dividend yield. You wouldn't think there'd be too much price compression left, but there's a huge wall of money that continues to chase these defensive yield names. The property sector, you know, these defensive infrastructure names are beneficiaries of that. So I think Transurban probably can remain strong coming into the December dividend, may pull back a little. Probably happy to have another look at it around $8. Telstra, so on these numbers, Telstra now trades at about 5.5% dividend yield, about 16 times earnings. The company delivered around about 8% underlying earnings growth. On a forward outlook, the company's guiding to much lower levels, probably somewhere in the order of 2 to 3% earnings growth. We should see the dividend kick up from around 29 cents up to around 31 cents on a full year basis. Our target probably sees Telstra trading up towards 5.75 coming into the February dividend, and I think it makes sense to have Telstra in portfolios. Toll disappointed, and this was one we're always cautious on. Their September quarter earnings update indicated that they're struggling to deliver earnings growth. It really is a cost-out story here with Toll. So the stock trades about a 5% dividend yield. Our base case is that it moves sideways here at around 5.50. We own it at lower levels, but we have been aggressive in selling the 5.75 calls. So a combination of that dividend and the call premium driving about 10% cash flow. Westpac, again, out of the banking results, about 7% underlying earnings growth. Stock trades on about a 5.5% dividend yield. I think we're likely to see a little bit of weakness post the dividend, but probably a month or 2 months following it, we would expect to see that dividend recovered, and at around sort of this 34.50 post the dividend, we look to sell the covered calls and drive sort of that extra cash flow out of banking stocks, as the general thesis is that they largely move sideways. Wesfarmers up here, 20 times earnings, 5% dividend yield, is starting to look a little expensive. I think again just highlighting this structure that we're seeing in the market where we're getting lower lows and lower highs, and these shorting signals. A little bit of caution creeps in to some of these names in portfolio, and where we can lock in profit, we certainly look to do so. Westfield, big beneficiary here of a lower Aussie dollar or strong US dollar. Strong earnings outlook for the property space there, but again, I guess put this in perspective, the stock trades about 19 times earnings and a 3.5% dividend yield, so it's getting pretty expensive. We may see some slight earnings upgrades to the 2015 numbers, which will help improve that picture, but around $8, one would have to think is pretty full value. Woolworths, their September quarter update disappointed investors a little, albeit the company did reaffirm that the full year earnings guidance will be between 4 to 7%, which just fits in with that range that investors should have always been expecting. I guess some risk creep in that maybe that comes in at the lower end of that range now, but the stock trades about 16 times earnings on a 4.35% dividend yield. I think coming into the February dividend, the stock can recapture $35, but it is a name that you have to be selling the covered calls over to complement that dividend yield, as there's limited capital growth from here in Woolworths short term. Woodside Petroleum trading on about a 5.5% dividend yield, not much in the way of earnings growth. So I think in light of where oil prices are at the moment, probably the right view is that Woodside largely just moves sideways. So again, to the extent that we're holding it, I think you have to have the covered call in place to warrant sort of that exposure to the equity risk at present. And just before I finish up and move back to AGK to conclude, this is the index of the top 50 stocks, and again this highlights this pattern that we've seen where we had the 10% correction that we're looking for. The market's rallied back sharply. We have this slight lower low, lower high structure. So in some of these names that are getting a little expensive, I think it just pays to be cautious. We're sitting on a little bit higher cash allocation in portfolios at the moment, and in the weeks ahead, if we're able to pick off some value, if the index was to fall back to say 5,500, that's what we'd look to do. The kind of names that we like, just running through those again just to summarise. Certainly AGK, as I mentioned, is good value. Amcor we like, but getting expensive up here. Some exposure to the banks makes sense. ASX I still think is a great buy, right? So we've been active in that. Horizon, AZJ, again, a great buy, right? BHP remains our preference within the resource space. Brambles we've been exposed to and continue to sort of ride this rally up in Brambles and sell the covered calls. We're driving cash flow out of Coca-Cola at the moment. Computershare looks interesting. Moving on from there, Insurance Australia sits on the radar now for the first time. Incitec, we've enjoyed this sort of rally back in that name. Lendlease, I think, starts to look a little expensive. Some of these oil and gas plays, I think, are worth starting to add to portfolios. We've locked in some gains in Sonic and a few other names, and the defensive mix of the usuals of Telstra, sort of your Transurban, Sydney Airport, Westfield, Wesfarmers, Woolworths, all make up part of portfolios at present. Thank you for listening in. I look forward to speaking again next month.